Gold closed just below 4,830. Silver closed the week back above $80. If the war is back on and it escalates, everything is going to go down. If the recent pattern holds, then gold will go down too. Better means lower when it comes to inflation numbers, because the markets were looking for a 1.2% rise in prices on the month. The consensus was 4.7. But if you own a property, it's not your privilege to live there, it's your right to live there. And if you have a right to live there, the government doesn't have a right to kick you out just because you can't pay a property tax. And they're taxing income-producing property. You're paying the tax out of the income that the property produces. But if you're taxing non-income-producing property, then clearly it's not an income tax. You're really confiscating the property. You're forcing the owner of that property to go out and get a job or find a way to pay rent to the government for the privilege of living in their own property. But taxing some little old lady who's living in a property and she can't afford to pay the property tax, so she's got to leave, that's not fair. Meanwhile, gold and silver, they rallied. Gold was up 2.5% on the week. We're not above 5,000 yet. In fact, we're not even above 4,900, but we are above 4,800. Gold closed well off the highs today. It was only up about $40 by the end of the day. I think earlier today it was up about twice that much. But gold closed just below 4,830. Silver had a much better day and week. In fact, silver closed the week back above $80, $80.70. And in fact, intraday, silver traded above $82 today. And silver on the week gained, where did I wrote that down? Silver was up 10%, almost 10% on the week. So silver actually beat Bitcoin on a weekly gain. The mining stocks did okay. You know, there was some weakness in Newmont that helped pull the GDX down. It was only up 1.9%, so not quite 2% on the week. But the GDXJ, which, that stock has a smaller impact. In fact, I don't even think it's in there. GDXJ was up 4.5%. So just a little bit less than the S&P. But, I think gold and the mining stocks are still the best way to play this war, because we still have no idea whether the war is over or not.
The bigger signal was not gold rising, but silver quietly outperforming nearly everything else in the room. As Peter Schiff points out here, silver gaining almost 10% in 1 week, while gold added just 2.5%, suggests investors may be rotating toward higher beta protection instead of simple safety. Mining shares lagging the metal itself also shows institutions still are not fully trusting the move despite geopolitical risk. When metals climb faster than the companies digging them out, it often reveals hesitation beneath bullish headlines. Next, Peter Schiff discusses why war uncertainty could still reshape this entire trade.
And the war could just as easily be back on Monday as it was off on Friday. And if the war is back on and it escalates, everything is going to go down. Now, if the recent pattern holds, then gold will go down too. But I expect the recent pattern to eventually break, because the war is bullish for gold. Now, gold's going up regardless of what happens with this war. But certainly the longer the war continues, the better it is for gold. I don't care how the markets have been reacting to this short term. The markets are wrong. They're all trading off of the oil price and the impact that they think that is going to have on the Fed and whether or not the Fed's going to cut rates. It doesn't even matter what the Fed does with rate cuts, because if the Fed doesn't cut rates, rates are still going down because inflation is going up. That is the bigger problem, which means real interest rates have been falling the whole time, that the markets have been focused on what the Fed is going to do. The fact that the Fed has done nothing means it's done something, because the Fed has allowed inflation to go up without matching that with rate hikes. And so the Fed is allowing interest rates, real interest rates, to fall. In fact, the Fed's balance sheet continues to grow. The balance sheet, again, in the most recent week, up about another 11 billion. Now we're over 6.7 trillion balance sheet. Again, the balance sheet is up over 200 billion this year. The Fed is doing quantitative easing. Money supply, as I said, is up better than 5% year on year. This is a highly inflationary monetary policy, and it will be even more inflationary the longer this war continues. So I think that when you play with gold, you could win both ways. If the war is really over, gold's going up. But if the war is back on, gold may go up anyway, because eventually that is going to happen. But obviously the war continuing is not a good thing for the markets, even though we are at record highs in the S&P and the NASDAQ. But, we got some inflation news. Speaking about inflation, earlier in the week, we got the March producer prices. And the markets actually rallied on this news because the numbers came out better than expected.
Markets may be reacting to oil headlines, but liquidity often tells a more honest story than fear does. As Peter Schiff points out here, a balance sheet above 6.7 trillion in money supply growth above 5% suggests policy is still looser than many investors want to admit. Wall Street keeps framing everything around future rate cuts, while real rates quietly weaken because inflation is moving faster than policy. That disconnect can leave stock investors exposed if confidence suddenly shifts from growth into preservation. Next, Peter Schiff unravels why inflation data may not be as comforting as markets believe.
And better means lower when it comes to inflation numbers, because the markets were looking for a 1.2% rise in prices on the month, March. And of course, March is the month where we started the war and oil prices shot up. But we didn't get a 1.2% increase. It was just a half a percent. And the February number that was originally reported at up 0.7 was revised to up 0.5. So the market was relieved. Year over year, producer prices only rose by 4%. The consensus was 4.7. So this was, hey, good news. But it's not good news. Who cares what the expectation was? Look at the reality. Year over year, prices are up 4%. The prior month, they were only up 3.4. That is double the Fed's target, and we're headed in the wrong direction. We're going up, we're not going down. And even if you strip out food and energy and you look at the core, prices were up less than expected. They were up 0.1. Expectation was 0.5. And once again, they revised down February. But year over year, the core is still up 3.8. Yes, it's slightly lower than the 3.9 from February, but nowhere near 2. And even though it's inched a little bit lower, I don't believe these low numbers. I think they're going to be revised the other way. I don't know how it is that the number was so low, even though it was still high. It should be a lot higher, and it probably will be a lot higher when we get these April numbers. But this is bad news, and this shows that rates are too low, and they're going to continue to stay low.
Sometimes the market celebrates numbers simply because they are less bad than feared. As Peter Schiff points out here, producer prices still running at 4% year over year means inflation remains double the Fed's target even after traders cheered the softer monthly print. Investors often focus on whether data beats consensus instead of asking whether the underlying trend is improving at all. When inflation slows only on paper, while purchasing power keeps eroding, portfolios can become more vulnerable than indexes suggest. Next, Peter Schiff talks about how policy distortion extends beyond inflation into everyday ownership itself.
One other thing, too, I wanted to mention, and I'm not sure how I started posting about this, but there seemed to be a lot of, posts on X on property taxes. And I weighed in on it, and I thought it was a good topic, so I should also discuss it on the podcast. But I don't agree with the concept of property taxes on properties that don't produce income. Now, the federal government doesn't have property taxes because those are direct taxes and they would have to be apportioned. And so we don't have them on a federal level. But on a state level and a local level, a lot of governments generate a lot of their income from property taxes. And property taxes can be very high. The property tax on my house in Connecticut is very high. Now, the problem with a property tax on a piece of residential property that you do not rent out, that you live in yourself, is that you have no way to pay the property taxes unless you have other income, unless you have a job or some other source of funds. But what if I'm retired? What if I have a house, I paid off the mortgage, and I don't want to work anymore? I just want to live in the house that I own.
The risk most investors miss is that ownership can become an ongoing expense instead of true security. As Peter Schiff points out here, property taxes on non-income homes create a system where retirees may still need outside cash just to remain in a house they already paid for. That matters because many Americans treat home equity as their safest long-term asset. When carrying costs keep rising after wages stop, even conservative households can be pushed into forced financial decisions. Next, Peter Schiff discusses why that burden can quietly redefine what ownership really means.
I don't need a lot of money. Maybe I have a vegetable garden in the back, and I grow my own vegetables. Maybe I got some solar panels, and I don't even have a high electric bill. But what if there's a high property tax? What if I can't afford it? I mean, it's like you have to pay rent to live in your own property. But if you have to pay rent to the government to live in your own property, do you even own the property? How do you own a property if you're paying rent to the government to live in it? And if you can't pay the property taxes, you got to sell the house. You know, a lot of people, when they retire, one of the reasons they have to sell their homes, even if they no longer have a mortgage, is they can't afford the property tax. And a lot of times, you know, the property taxes go way up because the assessed value of your house goes up. But that doesn't matter to you if you're not selling the house. The house is the same. But if the value is going up and now your property tax is going up, I mean, unless you're going to borrow money against the house, how do you pay it?
A rising asset can quietly become a financial liability when paper wealth creates real monthly pressure. As Peter Schiff points out here, homeowners can be punished by higher assessments even when they never sell and never generate income from the property. That creates a dangerous mismatch because retirees may look wealthy on paper while cash flow remains painfully tight. Investors should understand that inflation does not just lift portfolio values. It can also raise the cost of holding what already belongs to them. Next, Peter Schiff shows how that pressure changes the meaning of financial independence itself.
So property that doesn't generate income should not be taxed. Property taxes should be levied on income-producing property, and that's it. So if I own a residential house and I rent it out and I collect rent, okay, yes, let the city put a property tax on that. So landlords who own rental property, they can pay property taxes because they can get the tax revenue from the rent. They can raise their rents and collect money and now pay property taxes. Commercial properties, if I have, an office and I'm running a business, that property can be taxed because the business is generating income. And I can pay the tax from the income that the business generates. If I have a store, what if, I have a restaurant, I have a clothing store, I'm selling clothes, I'm selling food, money is coming in. I can use some of that money to pay property taxes. So I'm totally fine with, municipalities, states levying property taxes when the property produces income out of which the tax would be paid.
The distinction here is not taxation itself, but whether cash flow exists to support it. As Peter Schiff points out here, taxing income-producing property treats the asset like a business expense instead of a forced personal liability. Investors understand this instinctively because office buildings, rentals, and retail space are valued by the income they generate, not by emotional ownership. The deeper issue is that governments often blur the line between productive assets and personal shelter when revenue pressure rises. Next, Peter Schiff discusses why that blurred line becomes much harder to defend when retirees are the ones carrying the cost.
But when you're talking about taxing some little old lady, who's living in a property and she can't afford to pay the property tax, so she's got to leave, that's not fair. If you own the property, it's your property. You shouldn't have to pay a tax to live in your own property. Now, some people will say, well, what about for the services? Well, most of the property taxes, I'd say 70, 80% of the property tax in most towns goes for the schools. Well, what if I'm retired? I'm 70, 80 years old, 90. I don't have any kids in school. Why do I have to pay property taxes to send somebody else's kids to school? It's not fair. Now, you could say some of it is, well, for police protection or fire protection. But you know what? That's such a small amount of it. And to the extent, look, they can send a bill, right? If they have fire insurance on their house, it can be covered through the insurance companies. The amount of money that goes for the fire protection and the police protection is minimal.
The emotional part of this argument matters because policy often looks clean until it hits real households. As Peter Schiff points out here, when 70 to 80% of local property taxes fund schools, retirees without children can feel like they are financing a system they no longer use. That does not automatically make the tax wrong, but it does expose how one-size fiscal policy can ignore changing life stages. For long-term investors, these local costs can quietly erode retirement planning more than market volatility does. Next, Peter Schiff shows why alternative funding models deserve more attention than most officials admit.
I'd say that the commercial property, the rental property, the office buildings, and the sales tax revenue that they get. Remember, police and fire protection don't have to be funded out of property taxes. Cities and states have all sorts of ways to generate revenue out of which they could pay for the fire department. And of course, sometimes the fire departments are volunteer anyway. They're not even paid for out of the tax revenue. You have volunteer fire departments. So I think it would be fine to not have property taxes. I think cities and states can run without them. But, certainly if they exempted non-income producing property, they can keep the taxes on all the rest of the property. And even if the taxes have to be a little higher on the income producing property, in order to eliminate the taxes on the non-income producing property, that is a much fairer system. And it also, if you want to incentivize home ownership, that's an incentive. An incentive to own a home and means that you don't have to pay these taxes.
What sounds radical at first is often just a challenge to an old revenue habit. As Peter Schiff points out here, local governments already collect sales taxes, business fees, and commercial levies that can support essential services without leaning entirely on homeowners. The real resistance usually comes from political convenience because recurring property taxes are predictable and easy to collect. Investors should recognize that stable government revenue often matters more to policymakers than fairness in how that revenue is sourced. Next, Peter Schiff unravels why ownership itself can start looking more conditional than permanent.
You don't have to pay property taxes if it's your property. You own it. You have a right to be there. What the government taxes is not the fact that you own the property, but that you use the property to generate income. So once you turn a property into an income-producing property, the government is taxing it generally because it's generating income. and they're really taking a part of your income, even if it's not called an income tax. That's what it is, right? They're taxing income producing property, and so it's a form of an income tax. It's just you're paying the tax out of the income that the property produces. But if you're taxing non-income producing property, then clearly it's not an income tax. You're really confiscating the property. You're forcing the owner of that property to go out and get a job or find a way to pay rent to the government for the privilege of living in their own property. But
the language around taxes often hides what the cash flow reveals underneath. As Peter Schiff points out here, taxing income-producing property can be viewed as a claim on earnings, but taxing a personal residence feels more like a charge on possession itself. That distinction matters because investors routinely separate productive assets from personal assets when managing long-term risk. When governments stop respecting that same difference, the definition of ownership becomes less clear than many people assume. Next, Peter Schiff discusses why that uncertainty can eventually spill into broader confidence across financial markets.
But if you own a property, it's not your privilege to live there, it's your right to live there. And if you have a right to live there, the government doesn't have a right to kick you out just because you can't pay a property tax. Anyway, that's it for today's podcast. We'll see what happens next week. We'll see if the war is really off or back on. And in the meantime, keep on buying gold and silver. I think they've got no way to go but up. Go to schiffgold.com. Keep looking at the mining stocks and look at the Euro Pacific Gold Fund, EPGIX, emerging markets too. The emerging markets, to me, really look they're primed for a big move. I would also look at our emerging market fund. The U.S. markets are toppy. Yes, they made a new high. But I would not be looking at the U.S. I think John Paulson is right. We are headed for a sovereign debt crisis. That's going to be horrible for stocks. It's going to be horrible for bonds, but it's going to result in a boom in international stocks, in commodities, and that's where you want to be focused.
The shift from property rights to sovereign debt risk is more connected than many investors realize. As Peter Schiff points out here, concern over government overreach at the local level often mirrors the same fiscal strain building inside national balance sheets. When debt keeps expanding while US equities sit near highs, complacency can become more dangerous than panic for diversified portfolios. Commodities and international markets usually start attracting attention only after confidence in domestic policy begins to crack.